Good morning, everyone, and welcome to this online policy dialogue organized by the European Policy Center on Sustainable Finance, Accelerating the Green Transition in Europe and Beyond. My name is Simon Dekeyrel, the Policy Analyst for Climate and Energy at the European Policy Center, and I will be moderating the event for you today. This policy dialogue is part of the EPC's project on achieving the full potential of green finance in cooperation with the UK mission to the EU, which also includes a discussion paper that is now available on our website. The focus today will be on the regulatory and policy developments in the area of sustainable finance at national, regional, and global levels. Sustainable finance has become widely recognized as a key tool in the decarbonization of the global economy. By integrating ESG considerations into investment decisions, it can redirect financial flows towards sustainable economic activities and function as a catalyst of climate action across the globe. A first necessary step in this process is the creation of a common language on ESG matters on the basis of transparent, comparable, and reliable data, which allows investors to determine what is sustainable and what is not, and enables them to make informed decisions. After years of slow progress, there is now a regulatory race to improve the functioning of ESG markets at global, regional, and national levels. The International Sustainability Standards Board, or ISSB, a new standard setting body which was announced at COP26 last year, is developing a global baseline for sustainability reporting. There is, of course, also the EU's sustainable finance strategy, including the taxonomy classification system for sustainable activities, the UK's green finance strategy, and the US's SEC's proposal to standardize climate-related disclosures for investors. Today's event aims to discuss the state of play and prospects of these initiatives, but also consider how they can be coordinated in order to operate effectively alongside each other. To discuss this topic, we have three speakers joining us. Sue Lloyd, Vice Chair of the ISSB, Chris Faint, Head of the Climate Hub Division of the Bank of England, and Olivier Boutellis-Taft, CEO of Accountancy Europe. I would like to thank all three of you for taking the time to be with us here today. And so we will first have introductory remarks from each of the speakers, after which we will open the floor for questions from the audience. I would encourage participants to already write down any questions you may have during the presentations of our speakers using the Q&A function of Zoom. But if you wish to do so, you may also intervene directly during the Q&A session by raising your hand in Zoom. Without much further ado, I would then like to hand over to Sue Lloyd, Vice Chair of the ISSB, to share her reflections on today's topic. Thank you very much.
Thank you, Simon, and thank you for the kind introduction. So I'll start off by talking about what our objectives are, perhaps, for the International Sustainability Standards Board and what we are hoping to achieve as our part of the jigsaw towards supporting the move to a more sustainable financing environment and more sustainability, I think, more generally. So as Simon said, I'm the Vice Chair of the newly established International Sustainability Standards Board. And that board's really all about trying to achieve what the International Accounting Standards Board did, but for information about sustainability risks and opportunities. So our objective is to make sure that we have a basis for decision making for those who wish to make investments, both with a particular strategy in mind from a sustainability perspective. Increasingly, investors have got particular preferences that they're interested in, but more generally to make sure that investors really understand the risks and opportunities that arise from investing in companies, given the exposure of companies to particular sustainability risks, including climate, but not only climate. So what are we doing there? The International Sustainability Standards Board is aiming to make sure that investors around the world have got a robust and transparent basis for understanding the effects of sustainability risks and opportunities when they make their investment decisions, and that they can make those decisions in global capital markets with confidence that they have high quality information that can really be compared irrespective of where the company that they want to invest in is based, by having this global baseline of information. So at the moment, we have two sets of proposals that are out for comment, and they're designed to form the basis for robust information that would be of investable quality from an investor perspective. A lot of what the ISSB is about is reducing fragmentation. We have got a situation where there's been an increasing demand by investors and others for information about sustainability risks and opportunities, and that has led to a number of separate initiatives, some voluntary, some government-led, with different approaches and different disclosure requirements. And that's led to quite a lot of confusion in the market, both for companies to work out what's the best reporting, but also for investors and others to really understand whether they can make valid comparisons between different companies. We're hoping to reduce the fragmentation by taking noise out of the system. And part of what we've done is consolidated with some of the existing standard setters, the Climate Disclosure Standards Board, and shortly with the SASB, the Value Reporting Foundation, to reduce the alphabet soup that the market has been well known for. We're now working on building a comprehensive global baseline of information that investors around the world could use to make their investment decisions. Now, one of the complicated things, of course, in this space is that many are interested in sustainability information. And it's not only investors who are interested in having information about sustainability. And so the ISSB has been set up knowing that we're going to need to work in partnership with others. Our objective is to have a global baseline that investors around the world can really rely on to make comparisons in global capital markets, but we want to work with others. And we want to work with others for at least two reasons. One is because that we know that particular jurisdictions, whether they're focused on meeting investor needs or broader needs, are going to have particular disclosures that are important in jurisdictions. And that's a very valid information need. We also know that while we're focusing on meeting the needs of investors, that there are also others with an interest in sustainability information, including for public policy reasons. And so there may be incremental information that is necessary to meet the needs of those other than investors. So for that reason, the ISSB is not working in isolation. We're working with jurisdictions, we're working with others, including the Global Reporting Initiative, with this idea of using a building block approach. So we have a global baseline that we'll develop with others to meet global information needs, but then we want to work with jurisdictions and others to identify, in partnership with them, incremental information needs, incremental building blocks, if you like, that could be added on top of the global baseline to meet jurisdictional needs or broader information needs. We really want this model to work because it will be an efficient and an effective system. If you think of it from a company's perspective, if you're able to apply the ISSB's requirements to meet your investor needs anywhere in the world, no matter where you're reporting, and then in addition, add additional disclosure requirements to meet particular jurisdictional or broader information needs, that's a really efficient and effective system. It means that companies have a more streamlined approach to disclosures in partnership with the benefits that come from investors. So that's what we're working really hard on at the moment in conjunction with jurisdictions. Firstly, to build this global baseline and to make sure that it's truly acceptable and appropriate for global use for large companies, small companies, and in different parts of the world, but making sure that we're working in partnership with others to meet jurisdictional needs. If it's okay, Simon, I might just talk really quickly about what we're doing on the climate front, just to set the scene, just for a couple of moments. So as part of the global baseline that we're building, we have two sets of proposals that are out for comment at the moment until the end of July. A general requirements document, which sets out the overarching requirement to provide sustainability information for investors, and a climate document, which sets out particular proposed climate disclosures as part of our global baseline. Now, I think what's important to say is we're focusing on meeting investor needs, but investors are also really interested in the impact that a company has on people, the planet, and the economy, and that's because that also affects the value of a company's shares and its debt. Increasingly, the actions that a company takes for example, in relation to the climate, can lead to regulatory action, which affects the business model of a company going forward. It can lead to reactions from customers and those who may or may not want to work for a company. So the action that a company has on climate, for example, its GHG emissions, is also important for investors to understand. And so the global baseline that we're developing for climate explains the effect of climate risk on a company, but also the effect that a company has on climate when it's relevant to understanding investment decisions for a company. And actually, there's a lot of commonality in, for example, the information that Europe is looking for from a double materiality perspective and our work on climate. But our climate disclosures are designed to ensure that investors understand the risks and opportunities that a company is exposed to as a result of climate change. And so little ad break to really encourage people to respond to our proposals, which are out for comment for another couple of weeks yet. Thank you, Simon.
Thank you very much, Sue, for giving us a bit more insight into the activities of the ISSB and the importance also of the global baseline for sustainability standards for investors and for companies alike. Then I would like to hand over to Chris Faint, head of the Climate Hub division of the Bank of England, to give us a UK perspective and a central bank's perspective on today's topic. Yeah, the floor is yours.
Great. Well, look, thanks for inviting me here to speak today. As you said, I work at the Bank of England, running the division that coordinates sort of our climate work. And whilst the bank is independent from government, obviously we work very closely with the UK government as they seek to develop a green finance market. In terms of what we've been really focused on at the bank, we're focusing on the risks that arise from climate change and the transition to a net zero economy. And we've been looking at this for a number of years now and trying to develop tools and develop techniques within finance to understand the risks better. But of course, whilst our remit is focused on risks, we are not just focused on risks, because you can't manage risks unless you've got a sustainable market that allows you to understand the risks and move into opportunities, identify opportunities. So it's really important to us that the sustainable market is built out in a way that allows opportunities to arise and for the market to operate efficiently, pricing in both opportunities and risks. But in order to do that, you need to have a full toolkit. Just parts of the toolkit will help, but you need to have a number of different tools, from labeling, disclosures, to transition plans and others. And as Sue has just talked through, there's a huge value in having organizations that are looking at this, that don't just look from a single jurisdiction, but look across jurisdictions to help create cross jurisdiction consistency, which is of course always valuable in markets. But going back to what we're doing at the bank, today's panel is actually pretty opportune in terms of timing. Just over a month ago, we released the results of our climate stress test or scenario analysis, and actually just at the end of last week, the ECB released the equivalent results from their exercise. And I think this is really relevant, because whilst these exercises are focused on looking at how institutions, mainly banks, but also in our case insurers, will manage a transition, what will happen to their business models and risk profiles through a transition, actually these institutions reflect what's going on in the real economy. So these exercises are not just about what's going on in the financial system, but it's about how the real economy is adjusting, what that means for the financial system, and therefore what it means for our understanding of risks and for opportunities. So with that in mind, what I thought I might do is just spend a couple of minutes talking through what we found in our scenario analysis exercise and how that is relevant for the discussion today. So taking a step back, what is a scenario analysis exercise? Well, we think it is not only a useful tool in itself, but a really important building block as we look to sustainable finance toolkits. And that is because in a world where we don't know what's going to happen, frankly, you need to be able to look at a number of different pathways to understand different opportunities and risks. And we think the best way to do that is to run scenarios to understand how different situations will evolve over time, and then to ask institutions, how will you react against those situations? And the NGFS, a group of international central banks, has been working to try and advance this agenda by developing scenarios that can be used. What we did in our exercise was we said, well, let's look at 3 scenarios. Let's look at a scenario where there is no transition at all, and in that scenario, physical risks build up. A scenario where you have a late transition around 10 years time, and it's very sudden, and then you squeeze all the transition into about 20 years. And then we model a different scenario where we say, look, let's have a transition from today that's relatively orderly. And then let's look at what happens to institutions through those three scenarios. In a way, what that's doing is bookending what can happen. And importantly, the reason I've been calling this a scenario exercise and not a stress test is that these scenarios have not been calibrated to throw everything at the scenario. It's not the worst case or deep into the tail. It's just saying, how can these events arise and what does it mean for firms? So we ran this over the last year and a half with the 8 largest banks in the UK and a similar number of the largest insurance companies in the UK. And we released a whole load of information about the results, but let me just highlight 3 or 4 items that I think are particularly interesting today. The first one was from the risks that we modeled. We identified that the hits would be significant. In the scenario where the transition is delayed, we think over the 30 years, if you were to average it out, that could be a hit of 15% of profits consistently through the period. However, we don't think from what we've seen that the hits would be solvency defining, i.e. it wouldn't bring down the institution. But that said, we've only looked at one of the risks. We only looked at credit risk. We didn't look at risks in the market. So that would push risks up. And also risks will not be evenly distributed. They will cluster in some sectors, they'll cluster in some regions, and they'll cluster in some firms. So therefore, we should not expect that these risks would not create an issue. But what they do show is that in the absence of clarity on future policy, firms are having to deal with a huge amount of judgments, a huge amount of uncertainty. And I think that is my first point from this exercise. There is a huge need, huge value in us having more clarity from governments around the world on their policies to get to net zero. In the absence of those policies, firms are having to make a lot of judgments, and there is a lot of risk that is not that we can't currently plan for in a lot of detail. The second learning that I take is that what this exercise has shown is that there is a huge variety in modelling and understanding of risks and opportunities across firms. And that is because there's actually just a dearth of consistent information on what is going on in the real economy. And so to draw that out, one of the key things that we asked firms to do in this exercise was to reach through to their largest counterparties and say to those counterparties, well, how will you be impacted by these scenarios? What will these scenarios mean for your business model, your risks, your opportunities? And the reason they've had to reach out to those counterparties is because currently those counterparties do not disclose that information in a huge amount of detail or in a consistent way. When we looked at what firms took from their discussions with counterparties, when you had 2 banks with the same counterparty, one bank assumed that the impairments from that same counterparty would be 10 times greater than the other counterparty, than the other bank. So that shows that there's a huge spectrum of judgments that can be made based upon the similar discussions with counterparties. And what I think it speaks to is the real value in having more disclosure, more consistent disclosure, and disclosure that is better understood by those that are reading it. There's a lot of progress to be made in that space. And then the third point I was going to flag is that we asked firms to undertake the scenario exercise using a fixed balance sheet. So essentially what we said was, don't move your lending, but we'll just look at how your current book will evolve over these 3 scenarios, over the 3 decades that we modeled it. So in essence, what we're saying is how vulnerable is today's business model to risks that can arise in the future. But we did say to firms, look, but just tell us, how do you think you would have changed your bookings, your business models, if you had been allowed to change your lending profiles through the period? And in many ways, it wasn't surprising. What institutions told us was that they would be looking to move away from those sectors that are the more the dirty, more carbon intensive sectors where they thought transition risk was greatest. Furthermore, they would be looking to all move into the safer industries, which they consider to be some of the greener energy industries and some others, all at the same time. Now, what does this tell us? Well, when you add up all of the participants in the exercise, it is not clear that there's going to be enough capacity in those green areas for them all to move quickly, and at the same time. Furthermore, it's not necessarily a good thing for all firms to suddenly reduce funding and investment in those industries that aren't green. A transition is about turning the most carbon intensive areas and the grey areas into green. So from a financial stability perspective and from a smooth transition perspective, what we've identified is that there's a real need for firms to have the data from the market to understand how activities, industries, businesses will be transitioning over time to get to green. And we think there's a real risk if you just suddenly move to green. And for that reason, extra information on transition plans, taxonomies, particularly taxonomies that show how greenness will be achieved over time, are going to be incredibly useful. So it's against that backdrop that in the UK, if I use the UK as an example, we're very supportive of the sustainability disclosure regime, which is looking to implement a number of these developments over the coming years. We can get into a bit more detail, but they are looking to make disclosures mandatory, so TCFD, but ISSB linked disclosures mandatory over time, to look at transition plans where firms have targets, green labeling, and looking also at the feasibility of taxonomies. And I think this goes to my first point, which I will finish up on now. You need to have the toolkit. You need to have the toolkit that allows the whole of the green finance industry to develop, and it needs to be the right toolkit that allows the right tools to be used for the right purposes. I'll probably come back to it more, but one of the most important things in that, I think, is that it needs to be forward-looking. It can't just be point in time. Otherwise, it wouldn't give you enough information to think about how your profiles will change. With that, Simon, I'll stop. I look forward to having a discussion later. Thanks.
Thank you very much. And then finally, before we go over to the discussion, I would like to hand over to Olivier Boutellis-Taft, CEO of Accountancy Europe, who will give us a stakeholder perspective on these discussions and on the importance of sustainable finance initiatives, taxonomies, and disclosure standards. Thank you.
Thank you very much, Simon, and good morning, everybody. In reality, I'm kind of wearing two hats today. My hat as Chief Executive of Accountancy Europe, an organization that represents 1 million professional accountants, auditors, and advisors across the continent, and also my hat of co-founder of North Star Transition, an organization that actually tries to foster system change through multi-stakeholders, radical collaboration. So the difficulty with having two hats is that I suppose at the end of the day, what I'm going to say is pretty much my personal views. And I'd like to start by congratulating and thanking the European Policy Center. I think it's a very topical event. I would also like to congratulate the EU for its global leadership on this matter, which is quite unique. But maybe I should say the European Commission rather than the EU, because I'm not always sure that the member states are so much in the game. And the only small doubt I would have on the sustainable finance strategy, on paper at least, is that it has a little bit of a flavor of the Lisbon strategy, for those who remember. And I hope it's only a flavor and that it will not have the same fate in a way. So I'm going to speak about reporting, and I'd like to make 4 points about the 4 big debates that are taking place in reporting. I'd like to say a few words on the role of reporting in the transition. I'd like to speak about the granularity of reporting, an issue that is growing as everybody is answering many consultations from the ISSB, but also from EFRAG in Europe. I'd like to make also a few remarks on materiality, also big splitting debate, and on international versus European reporting. So very quickly, the role of reporting. Well, I think green finance is critical. I'm sure everybody's convinced around this table, and it's growing, which is good. I mean, it's projected to be about 1/3 of assets under management in 2025. Well, that means that 2/3 of assets under management in 2025 will be still brown or black. So the truth is, it is important and it is growing, but finance is just not doing the job that we need to do in just 3 years, according to the United Nations and the IPCC. So I know some people will disagree with me or even be shocked, but when we assess progress, I think we need to look at where we should be, not at where we're coming from. We're coming from 0 to 1/3, it's fantastic. But if you look where we should be, we're very far from doing the job. I mean, right now, we're still on a trajectory in terms of climate that is somewhere between 2.4 degrees and 3.5 degrees. That is the optimistic scenario. If you look at some of these scenarios that are run by armies, they think it's rather between 5 and 7 degrees. Well, that means a world in which none of us wants to live, but still has a pretty big chance to experience. This is not a matter for your generation, Simon. It's also a matter for my generation now. So reporting is important, but it is not a game changer to the required level, I think. And sometimes I do wonder whether policymakers are not kind of offloading on reporting, because it's a lot easier to ask other people to do the job than to take much more difficult measures around product standards, corporate governance, corporate purpose, tax policy, sobriety. I mean, there's a big list here. Now, coming to the granularity of reporting, and this is a new word that everybody's using, granularity, which I wonder whether it's not just a polite word for information overkill. Will more information really accelerate the change? I think that's really the question we should ask ourselves, rather than what is the information that we need. And when I look at developments now, I think the CSRD that Accountancy Europe would very much welcome, and the ESRS, sorry about all the acronyms, the standards that EFRAG is currently working on. I think that's a wonderful piece of work, but I also think it's just 20 years too late. So you'll tell me better late than never, but the problem is that when you're late, so late as we are, you don't have time to finesse and do things as you would have done them having the luxury of time. You go for key indicators, you go for proxies, estimates, efficiency and speed is what should prevail. You don't seek exhaustivity and perfection as ESRS seem to be doing. It's great, but it's just too late. And I think we should all agree that the purpose of reporting is not reporting. We're not doing reporting for the sake of reporting here. The purpose is to accelerate the change. So I suppose what we need is really clear and simple indicators that tell us that change is taking place and goes in the right direction. I was having a conversation yesterday with retail investors, actually, and they expressed that worry that is this overload of information really going to help us make the right decisions? And that brings me to the much debated point around financial materiality against double materiality. Well, I think we need double materiality, But the reason why we need double materiality is because our price system is totally flawed and doesn't integrate negative externality. If the price system was right, financial materiality would suffice. Anyway, I mean, most of the sustainability issues we need to report on are going to be very material financially very soon. You know, think about water, copper, soil exhaustion, climate events. I mean, all that is going to have a huge financial impact. So I think the only real question here is, will double materiality change investors' behavior? When a decision is optimal from a financial standpoint and suboptimal from a sustainability standpoint, what will they do? That's really the question we should ask ourselves, I think. And of course, you know, this debate around materiality, very heated debate, brings me to my concluding point, because sometimes we see again a kind of antagonistic discussion between international versus European standards. Well, the largest investment funds are global, the most impacting companies are global, and they all operate on only one and the same planet. Well, maybe at the exception of Mr. Elon Musk, but the rest of us are all on that same old Earth. All right. So I think this is not a competition. I wish it is a race, but a collaborative race. It's not a matter of sovereignty. It's a matter really of global corporations to collectively achieve the necessary results. These results cannot be achieved in isolation. So at Accountancy Europe, I think quite some time ago, 7 or 8 years ago, if I remember well, we called on everyone to start reducing the alphabet soup that Sue mentioned. And we called on the IFRS Foundation to develop sustainability reporting standards. We also called on the European Commission to take this head on. So today, we welcome these developments and the CSRD, but much remains to be done, and very quickly, and not only about reporting. Thank you.
Thank you very much for your comments also. So happy for participants to write their questions in the Q&A function of Zoom, or also comment directly by putting your hands up in Zoom. But maybe I can start off with a question for Sue first. So Olivier mentioned the need for double materiality because the climate risks are not priced in currently, but the ISSB is currently developing standards on the basis of a financial materiality perspective. Is this sufficient for bringing about the needed change?
Thanks, Simon. It's a really good question. And actually, Olivier said a few things that I really couldn't more strongly endorse. I think he made a couple of really important points. So I'm going to answer your question, but I also want to reinforce a couple of points that he made. Not least the need for cooperation. I don't think there's a necessary. It's not the case that there's one way and somebody has to win and somebody has to lose. I really think that this is the time for people to work together. And one thing that Olivier said, which I really agree, is this isn't about reporting. It's about affecting change and making sure people have the information they need. And we don't want people, going through several contradictory reporting exercises for compliance purposes. We want people actually focusing on dealing with sustainability issues with the most efficient means of getting there, and that's what we're all about. So what we need to make sure is that investors have the information they need, and that's what Olivier said. Investors need to have the information that they need, and this is what we're focusing on. I try not to use this word financial materiality because I find that it tends to confuse rather than elucidate these conversations. What we're saying is that investors need to be getting the information that is necessary for them to make their assessments about their investment decisions. And Olivier said, if people need information about sort of so-called double materiality, so impacts, for example, to make their investment decisions, they should have it. And I totally agree with that. And I agree with that so much that if it is necessary for investors to make their investment decisions, it comes within the scope of our work, because that's exactly what we're asking for. We're asking for the information that investors need to assess enterprise value and to make these decisions. I think the key thing here is that the way that we're crafting our requirements is intended to be dynamic, because we know that the information that investors need is actually changing over time. And so it's becoming closer to their interest in things about the behaviors of companies is becoming increasingly important. And that's one of the reasons why I think it's unfortunate to be distracted by this double materiality versus financial materiality distinction, because it's a non-distinction in many, many cases, and it's really a distraction. What I think is really important, and Olivier said this, is we want to make sure that people have got the information they actually need to make their decisions. Let's not ask companies to provide hundreds and hundreds and hundreds of different data points from a completeness perspective. Let's make sure that the ultimate filter, and this is the filter that the ISSB ultimately asks for, is we describe lots of different types of information, but at the end of the day, we say, provide the information that could reasonably be certain to actually influence an investment decision, like choose the important stuff. So we're trying to get a proportionate approach to the information that's provided to investors to make sure they have what they need, but they don't have all of this extra data points that actually are not going to influence their investment decisions, and it's not going to affect change because it's not really relevant to the decisions that they're making. And so I think that this granularity point is a really, really important one. We want people to focus on the key information that's really important to make these, to influence decisions and to influence allocations of capital, and to really, and that's what's key to addressing these sustainability risks.
Thank you very much. Also, maybe a follow-up question relates to the interoperability that's also often discussed between the different sustainable finance initiatives at the global level and also at the regional and national levels. How would you assess the importance of being of these frameworks being interoperable? Working together, and are they currently working together, and what is the risk if they do not work together?
Do you want me to answer that? Yes, or others?
Or others can also comment.
I think
so I'm happy to comment, but maybe Sue can go first, because this is
so this is
central to her work.
what keeps me awake at night. I think it's fundamentally important that it's interoperable, and the reason why it's fundamentally important is because otherwise we risk two things. One being that we actually don't get this global comparability for investors. If for example we have a regime where the information that's provided by companies in Europe is just different to that's provided by companies around the world, these global investors can't actually be sure whether they're comparing apples and apples or whether something looks different because the disclosures that they're asked to provide are different. And so we risk losing that global comparability from an investor and system perspective, which is really, I think, critical. The other thing is, from a company's perspective, we risk then having a situation where a company may need to provide a different set of disclosures to meet European, say, requirements or another jurisdiction's requirements, and then use a different set of disclosures to meet their compliance obligations in other jurisdictions. So then we have people spending their time and resources on multiple reporting regimes instead of an efficient single reporting regime that works well in combination with one another and focusing on addressing sustainability risks. And so I think both for those making decisions who need comparable information and those preparing the information, there's enormous risks of inefficiency, duplication, and confusion unless we get the interoperability. If we don't get the interoperability, we've just really got a new form of alphabet soup, really.
See, Olivier has his hand up, but maybe first, Chris, you also wanted to comment on this?
Yeah, thank you. I was just going to raise a related point. So we've rightfully spoken about the users of the information that comes from these disclosures. I think an incredibly important additional point is that it's not that these institutions who would be doing these disclosures necessarily have all this information to hand. It's not sitting on a desk somewhere and not being published. One of the fantastic things about the disclosures is that it creates the momentum and investment requirements within organizations to actually gather this information and to actually think about it. And we saw some of that with the TCFD program. Within the bank, when we did our own TCFD report, we started off thinking we had a pretty good understanding of our own risk profiles, but actually the process of doing it, the process of going through and actually thinking through what we'd have to disclose really exposed a number of areas where we didn't have as good understanding as we might have done. But I just wanted to really emphasize that point that Sue made. There's a real risk, and we see this in the regulatory side already outside of climate, but as soon as firms have to create a number of different versions of the same data, it becomes a compliance exercise, not a useful exercise for them that they then can feed into their strategic processes. And there is such a huge risk of it becoming a compliance exercise in this space, because you can have, in theory, the same outcomes of the disclosure, but so many different cuts of the data required to get to that disclosure. And the reason it's important for us to nail this now is that firms are looking to make the investment now on what kind of data they're going to have to create, what they're going to have to collect, and that is a large investment in many cases. So they want to do it once; they don't want to do it on multiple occasions. So I would be, I think that is a really compelling reason for us not only coming up with something that's internationally consistent, but looking to do it as soon as possible, so we can leverage those investment programs of firms now when they're most focused on it. Thanks.
Olivier, I'm sure you also have something to say about this.
I'm just going to add a very modest 2 cents contribution to this discussion. I mean, interoperability is a difficult word to say for non-native speakers, but it's also a big word, and you don't really know what's hiding behind it at times. And I think it's really starts with the basics. And I think if we're talking about interoperability, manage this time, we need to use the same language. We need to use the same definitions. We need to use the same structure. Okay, it's the basics that will enable, interoperability. If we're using the same words to talk about different things, or using different words to talk about the same things, goodbye interoperability. Okay. And I can't agree more with what Sue and Chris actually have said at a much, more important level. But I think we should also not forget, things really, down the ground. And again, why we need these reporting, it's to change behavior. It's to change the business models. It's not to get people to invest in reporting, okay, and make my members richer. That is not the purpose of the game, okay? And it's urgent. So I think we really need to all together work on that.
Thank you. Maybe so the ISSB has established a working group composed of representatives from the European Commission, EFRAG, China, Japan, the US, and the UK. Could you, Sue, maybe tell us a bit more about the activities of this working group and the next steps, and what are currently the barriers to achieve a consensus on the global baseline, considering that it's very important, as we've just discussed?
Thanks, Simon. So yes, the jurisdictional working group that we established a few months ago is really trying to seize what I think is a unique opportunity that we all have at the moment of having proposals being considered by a number of different parties simultaneously. I mean, we have to think about how fortunate we are in a way that we actually have a situation where we are currently considering the disclosures the ISSB would require at the same time that the SEC is considering their climate rule, and at the same time that Europe is thinking about the disclosures that support the CSRD. That gives us a really wonderful opportunity to build this global baseline, to really see if we can get this, so-called interoperability to work, commonality in what we're asking companies to do and in the information that's disclosed in different parts of the world. And so that's really the task of this group, to find ways to find common ground to help us build a global baseline that the members of the jurisdictional working group think they can get behind is really the objective of what we're looking for. And in so doing, to try and make sure that that global baseline works as well as possible with the particular jurisdictional needs that we know that countries and jurisdictions are going to have. So for example, we're not questioning the fact that, of course, Europe needs to have a package which fits in well with CSRD, and that's a particular European thing. But we're trying to work together cooperatively to identify opportunities to bring the ISSB's global baseline closer to what Europe's proposing in their exposure drafts, to what the US has proposed in their climate rule, not just for them to move to us, but to look for opportunities for the ISSB for us to move to them, if you like. And that's really the purpose of this group. So are there any barriers at the moment? I don't think there's any particular barriers that have been identified, other than the fact that everybody's being asked to do things really quickly. And when people feel that they're under time pressure, it can, create tensions in terms of how quickly you can change from what your idea was and still, meet what's asked of you as an individual organization. But we're continuing those dialogues, and we're also supplementing the jurisdictional working group discussions with the 5 members and us with bilateral discussions. So I'm talking a lot to my friends at the Commission and at the EFRAG to try and find ways to bring our proposals closer together. And similarly, we're talking to other members of that group on a bilateral basis. So we've all literally got our sleeves rolled up, looking for ways to bring our work closer together.
Thank you. And could you also tell us more about the main sources of disagreement, or the main source of divergence between different jurisdictions that is currently observed in this working group?
Yeah, I think that the main differences that have been identified, well, let's talk about some of the key differences. So the US is at the moment only focusing on climate, whereas the ISSB and Europe are focusing on sustainability risks more broadly. So that's one difference. If you look, though, at the climate proposals of the SEC relative to the ISSB proposals, there's a lot of commonality between those two sets of proposals. In particular, we've both used the structure of the TCFD, the Task Force for Climate-Related Financial Disclosures, this governance, strategy, risk management, metrics and targets as the basis of the architecture for our proposals, which makes us similar. We're also asking for similar things in terms of areas like scope 1, 2, and 3, information about the effects on financial statements. So there's quite a lot of commonality between what we're asking for and what the SEC is looking at. They go a little bit further than us in a couple of places because of their different mandate. So the ISSB doesn't deal with financial statements, our sister body does. So we have asked for information that explains the links between what's in the financial statements and what's in the sustainability reporting. The SEC, because they are the SEC, have gone further and asked for a particular note disclosure in the financial statements linked to information about climate risk. So that's a difference in mandate. And the other one that I would highlight is they talk about the particular assurance that's required, which is again the SEC's mandate, but not the ISSB's. But other than that, similar. The key difference probably I would highlight between us and the SEC is that we have proposed industry-based disclosures for climate and they do not. So that's probably the most stark difference for us. If you then look at the differences and similarities between us and the European proposals, I think getting to Olivier's points, which again I would agree with, Olivier, we've got a lot in common here, in terms of structure and words. One of the things that we're working with Europe on at the moment is word differences. For example, we've described the value chain, which is a pretty fundamental concept using different words. They've got a definition of financial materiality, which is different to our definition of enterprise value. They use the word material differently to the way we use the word material just as a general concept. So we're trying to work with them to find common language where we can, because I think that's one source of tension that we can remove. I think another difference that we have from Europe, which is important to us, is the fact that we've used the 4 pillars from TCFD that I mentioned. They use 5 pillars, so there's that structural difference. And then I think the other thing, of course, that's different between us and Europe is their focus on double materiality. And I think the biggest challenge that we have, if I look at where we are relative to Europe, and the thing that we're talking to our friends in Europe about at the moment, is that they don't separately identify the information that is relevant to investors from that which may be relevant to others. And one of the key proposals that we have in our general requirements exposure draft, which is really important to us, is that we want to be sure that investors, because of this global baseline, can see the information that's really important for them to make investment decisions, so they can make comparisons with global companies. At the moment, there's a large, I think, overlap between the information that Europe is asking for and what we're asking for, because they ask for more than us, because it's a double materiality focus and because it's much more granular than what we're asking for. But it could, I think, be difficult for investors to see within that large set of data that which is important for investment decisions and that which is common with the ISSB requirements. And so what we're talking to them about at the moment is whether there's a way of identifying the population of information that is consistent with the global baseline within the larger amount of information they're asking for from a double materiality perspective. And the last thing I'll say, and then I'll stop and let others join in, because I really would be interested in the views of others on this as well. We have an ultimate filter, which is only provide the information which is material in the classic financial statement sense, the information that could really affect an investment decision. Europe is much more along the lines of making the disclosures essentially mandatory for all companies, subject to a rebuttable presumption. So that is quite a key difference in the thinking and the design, which I think is important for preparers and for investors.
Yeah, happy for Chris and Olivier to comment. Maybe first, Chris, if you want to comment on this.
Yeah, thank you. So this is something that touches my world a little bit less. But one of the areas where it does touch my world, and I think it goes to that last point on materiality, is on the linkages between what's disclosed, market expectations of firms, and actually what that can mean for legal cases and liability cases. One of the things that comes up sometimes is that firms are concerned that if they disclose certain information, it will give rise to legal cases against them. But sometimes something that is material from a legal perspective might not immediately seem it. So I think there's a question about whether certain disclosures should be made that don't look material on the face of it, but could be material from through a legal lens. This is interesting to us because it gives rise to financial risk. We don't have a view on exactly what should be disclosed and what shouldn't, but I think it does go to a broader debate on what would the financial information be used for? How might those users of financial information for legal risks change the behaviors of firms, and the extent to which that is a positive change in firms rather than a kind of a knee-jerk reaction or something that might not be positive? That's something that we're looking at from a prudential perspective because it gives rise to risk, but I thought I'd throw that in because I know it's another angle of the debate that shows just how complicated this is.
Olivier?
Well, I'm afraid I'm pretty much going to repeat what I've said earlier on materiality, and probably it's not necessarily a mainstream opinion, but I tend to think it is a distracting debate. This debate between double materiality and whatever else is the other option. I think we again need to go back to the basics and understand why we need double materiality and whether double materiality is the answer to the problem we're trying to solve. So the answer to the why question is really in this fundamental flow that we have in the price system, which is, prices are only reflecting a very small part of the information. They are totally avoiding, all the environmental negative externalities and all the social negative externalities. So if by magic tomorrow morning, these negative externalities would be included into the price system, I suspect a number of people would stop making money because very often what we don't want to see, because we're just putting our heads in the sand, but negative externalities most of the time are a source of profit. Okay, that's what they are at the end of the day. It's a very nice theoretical term to talk about something else, which is very concrete. Okay. Now, if with this fantastic magic stick, we would manage to have a real price system that would integrate all these negative externalities, well, financial materiality would be just fine, okay? So that, I think, is for the more, basic theoretical backdrop of this discussion. But the real question we should ask ourselves is whether it is the answer to the problem. So what I mean by that is, if, and I think we can already answer a part of this question, when, anyone, an investor or a CEO has to make a decision and sees on the basis of the information that they have, that the decision is optimal from a financial standpoint and suboptimal from a sustainability standpoint, what decision will they make? Well, if you tell me that we have evidence today that the decision will be basically made in the public interest and not in the self-interest of the company, for instance, or the investor, then I think we're okay. I'm just not convinced.
Thank you. Maybe I'm looking at the questions from participants, and something which relates to a point that Chris made earlier. So someone says Mark Carney and the Brookfield Asset Management Huge Transitions Fund has been criticized for having said that they would continue to finance brown companies that work with fossil fuels in order to support them in their transition. So the question is, what is your opinion on this in relation to your earlier made points on the and should money stop flowing to such enterprises and be focused on sustainable ones, or is this rather counterproductive as you suggested, or do you think this would rather be counterproductive as you suggested in your introductory remarks? And also maybe another question that specifically directed to you. While the results from the Bank of England are somewhat unlikely to have direct consequences for capital distribution strategies in the immediate future, do you think that in the long run, add-ons to companies' Pillar 2 requirements levels could be introduced?
Great, thanks. It's quite a lot there, Simon. So I'll try and do it very, very, very quickly. So what I think Mark Carney was saying was that you shouldn't just immediately take away all the funding from activities or institutions that are doing work that is polluting, that is in the tail, that is deepest brown. What he was suggesting is that as an investor, they should be using their funding to help facilitate transition. Now, what does that mean? Well, that means that if you're going to continue funding, investing in an entity, you make conditions of transition on that entity. So if you were looking at a manufacturing plant, say your manufacturing plant was creating something that was very important, but it was using energy that wasn't particularly efficient, and it was using kit that was quite polluting, what you could say was, we recognize that you are creating a lot of pollution today, but we recognize that you have a valuable service. So how can you change your business, create an investment proposition for your business that reduces that amount of carbon pollution over time? And then through doing that, you can channel that investment into something that moves that activity along the spectrum towards green. And I think this goes to the investor proposition. If investors were asked, would you rather invest in something that is the most green today, or would you rather invest the same amount of money in something that generates the largest change towards green over time? I think a lot of investors would like to see the change, because after all, the movement to net zero is all about change. Now, if you don't do that, if the whole of the economy was to stop funding activities that weren't green, then what you'd see is a couple of things. I mean, the first thing is that actually I think the funding would still reach those entities. It's just it would reach those entities via funders that aren't necessarily publicly listed, where the kind of pressures are different. And it is not clear that that would actually create as much of a catalyst for transition as a publicly listed entity that does disclosure and is subject to market scrutiny. So, but if that funding wasn't available, and there's a lot of evidence to suggest that it would be available, then what you've got is a financial stability issue. You've got assets that could be stranded. You've got potential energy that couldn't be supplied, particularly for in emerging economies where coal doesn't have any substitute at the moment. So you'd have a human cost to that as well. So that's the background for what Mark Carney was seeking to address, and it is the core of that is supported by what we saw in our scenario exercise. So we see that there's some credibility to what he has said, and I'm not just saying that because he's my old boss. It's generally comes through in the analysis. And in terms of the second question, I mean, I think actually these scenario analysis exercises and the focus that they put on to what's happening in the economy do change will change the capital distributions in firms. Essentially what it's doing is it's saying it helps firms to identify where risks are, risks that might become inevitable and are likely not included in pricing at the moment. It would then allow firms to consider what the pricing of those activities should be, and then change their pricing accordingly. In some cases, that will lead to some suboptimal outcomes. For example, if you shine a light on the fact that there's going to be flooding in a certain area, that means that mortgages and insurance in that area might need to increase, and that will obviously have an impact on those people living in that area. And that's where governments come in. You shine a light on where the risks are, and then governments come in to help develop policy to address those risks as part of its broader net zero strategies. So I do think it does change the allocation of capital from firms. As we identify those risks, we will be checking to make sure that firms are holding enough regulatory capital on their balance sheets. We're still thinking about how that will work and whether you need to use conventional tools, new tools, buffers, Pillar 2, as mentioned in the question. That's something that's being looked at. But what we do need to ensure is that risks from climate that aren't currently included in our regime are adequately covered. And that could mean that firms need to hold more capital against those. If they do that, then it will change again the pricing of their products, because they'll have to raise their price on those areas or elements that are more risky. But that's something we're working through, both domestically in the UK and internationally through groups such as Basel. So it's definitely a space to watch. Thanks.
Thank you. I think a very interesting point you made is about if we, and that also comes back to comments made by Sue and Olivier, if we are really about bringing about needed change, then we should rather help those the most polluting companies, that's where we can really bring the most the needed change, that helping those most polluting companies transition towards a cleaner future. That is really where we can make the most difference. So maybe Olivier also wants to comment on this.
Going to be a limited
so
comment. It's going to be a limited comment because I think I fully agree with what Chris actually has said. I would just like to underline what conditional actually means. Okay, it means that conditions need to be fulfilled. In other words, if they're not, it needs to be consequential. And I think we live in a world where we're not always very, realistic on that. I think, fully agree, it needs to be conditional. We need a mechanism to know whether or not the conditions are fulfilled, and we need a mechanism to react and, if necessary, punish if the conditions are not fulfilled. And the other thing we need actually is a term. I mean, we can't, go on funding the transition forever. We need the transition to take place soon, now. And I'll tell you something on the transition. I think it's a very nice word, transition, it sounds like a very smooth and almost enjoyable process, transition. But I think, the transition is going to happen. The discussion we should be having is whether we're going to have an orderly transition or whether we're going to have a terrible, disruptive, and catastrophic transition. That's going to take place, okay? That's the arbitrage we're currently discussing in reality with all these nice words, and good intentions that we all have. So for me, it's a pretty clear choice, but the reality is that we're very late on this choice. So we need to fund, I think, massively the transformation of this most polluting business, but we need to have real drastic conditions to do so as quickly as possible. I think Sue wants to contribute.
Yeah, just to add something from my perspective. So firstly, from the sort of ISSB's perspective, we're trying to be neutral. So we're not sort of trying to, certainly not saying you should or shouldn't provide funding to particular types of companies, but we want to make sure that investors have got the information they need to make their decisions. And so I think transition is relevant for at least two reasons in that respect. One is, as the others have noted, this risk of transition is a real thing, and it's a really important thing. If you're going to give money to a company, particularly if you're a longer term investor, you want to know what the heck they're planning to do about climate change, because it's an enormous risk, but also an opportunity. So there's good and bad outcomes depending on what a company's plans are and how carefully they're thinking about it. And investors just need to understand what's going on so that they're informed when they make their decisions. But also we do know that there are those who are providing funding who want to take particular positions. So there will be companies who think that it's either a positive thing from a sort of ethical perspective or from a sort of intention perspective, or an opportunity from a funding perspective to get behind companies who have got a particular plan for transition. And they need the information to identify those companies and to track that planning. And I think we're starting to hear more from some involved in regulation for banks, etc., where it feels like it's likely that there will be particular desires from a policy perspective in terms of providing funding to companies undertaking transition plans. And if that's the case, we're going to need to make sure that those tasked with those policy objectives have got the information they need to know where they need, where they should be putting their money and to track what's going on. So it all comes back, of course, for me, to transparency about what's going on, which may be necessary for different purposes, but certainly not sort of implying that you should stop funding particular industries.
And a question, maybe a follow-up question to all speakers. Then, if everyone agrees that conditions would be necessary. What could those conditions look like? What is currently being done in this space by different jurisdictions, and maybe also at the global level? I don't know. Maybe yeah, Chris.
Well, one of the things that's happening in this space is the development of transition plans. So in the UK, they're looking to create mandatory transition plans where for certain groups of firms where they have targets. What these transition plans could do, if done well, is that they can create a market exposed pathway for how firms intend to not only reach their targets, but ideally how those targets are then aligned with the net zero targets of their countries. So you can see not only what they're doing, but their role in their nation's transition. But this is really challenging. I mean, in theory, what you could do is you could have a transition plan. It could be locked down, and then you could have a covenant in an agreement that says, you know, in 5 years' time, you said you're going to achieve X. Maybe it's carbon reduction, maybe it's certain amount of investment in certain activities. And if you achieve this, then the funding can continue to come. I mean, that would be one type of structure. But the reality is that at the moment there's some challenges to that. The first is that we don't know what the policy environment is that firms are having to act. So it's quite hard for them to have a transition plan that's locked down and won't move. The second one is that we don't yet have international agreement on what a good transition plan looks like. Going back to the points that Sue and Olivier made before, there's some appetite in some quarters for it to be exceptionally detailed, but others are saying you should keep it more high level. And then there's other considerations such as, you know, if you're doing a transition plan, what's the, you know, what do you bet, what are you comparing that to? What's the counterfactual? What scenario are you doing it to? Do you need to do it across a number of scenarios just in case different things happened? So I think I think it is easier said than done to create targets that are consistent and applicable to firms to keep them real. But I guess, you know, elsewhere in the market outside of climate, we see covenants developed on a case-by-case basis that aren't necessarily linked to something that is consistent. It can be idiosyncratic to a specific organization, and those are developed. Those can be developed at the moment, and those would be subject to agreements between a lender or another organization and the counterparty. But that is not necessarily optimal, because for the reasons we've said before, the more comparability you have in this space, the more interoperability between countries you have in this space, the better the market can operate, and the better scrutiny we can have over what's going on. So definitely agree. There's some challenges to doing this, but I don't think it's impossible in the current environment. It's just, it might be a little bit trickier than if we had all of the tools in place.
Maybe a question for Sue. Is this also something that is in what kind of way, or how is this being developed or being discussed within the ISSB, these conditions for these conditions for in transitions plans for companies?
Well, so our approach is really to make sure that there's transparency about what companies are doing. So we don't, at least in the proposals, require, for example, that a company have a transition plan, but we require that, or propose requiring that information be provided about what the transition planning of a company is, what its carbon emission strategy is, and how it plans to get there. And also we propose disclosures around, you know, what the consequences for a company's strategy would be of different climate scenarios. So they're all sort of related to transition planning in some way. We don't say, you know, you have to have a transition plan and it has to have particular characteristics, because we are about asking for information about what's happening as opposed to requiring particular actions from a company's perspective. That's not the role of somebody focused on disclosure. Having said that, we are really interested to make sure that we're aware of developments in terms of requirements for transition planning, etc., from GFANs and others, to make sure that when we're crafting our disclosures, they would sort of result in a company that was using some of these planning materials to provide information about what is going on, because we expect it to be of interest to investors. So that's sort of my neutral sort of perspective, but we are, you know, really aware that this is an area that investors are really interested to understand. And what it does mean is that a compliant disclosure, if you like, in the extreme, would be, I have no transition plan. And I wish a company luck in their conversations with their investors if that's their answer. But strictly speaking, you know, we ask for information about what you're planning, and so a valid answer is nothing. But you know, we hope that's not the answer, just to be clear. But that's sort of the design.
I think you're on mute, Simon. So I suspect you might be asking me to comment after Chris, since you.
Exactly, yeah.
Okay. Well, I don't have much to add, but I'd just like to, you know, just throw another remark open. I think most of the things we're talking about today are easier said than done. Okay. But we should not forget that they need to be done nonetheless. And I think when it comes to reporting and having transition plans and delivering on these transition plans, it would be great, but maybe I'm dreaming. It would be great that governments actually show the way. Because the truth is that if we look at all the pledges and treaties that have been made and all the commitments that have been made, many are simply not implemented and not followed, which is the reason why we're actually 1 degree above actually the Paris Agreement. So I think it would be good that governments show, you know, leadership by example. And as we're talking about reporting for the private sector, of course, we should not forget that we live on a continent where more or less half of the economy is more or less in the hands of the public sector. Varies from country to country, but that's a reality. So maybe one day soon, we should also be talking about how governments are going to report on these matters.
Thank you. Maybe also something, a question I had for Chris specifically. How would you see or the role of central banks in this whole sustainable finance space, or what, or how, or can you tell me what the bank's perspective is on this?
Yeah, thank you. That's a pertinent question. So central banks, in theory, can have a lot of power. In order to make sure that they focus just on the areas that are important to them, they're given remits by their governments. So we as a central bank operate within a remit. We've got a financial stability remit to make sure that firms and the economy are stable, and we've got a monetary stability remit. And in the UK, that's the remit through which we set interest rates. As I mentioned before, typically the focus of central banks globally is on risks because of those remits. You want to understand how risks are going to evolve today and in the future, and look to ensure that those risks are being managed proactively. But it's not that straightforward that we just look at risks, because you need to understand how risks can be mitigated. You need to create the right environments for risks to be mitigated. And you need to be working with institutions to ensure that they're thinking about those environments and actively partaking in them. So because of that, as the bank, we are actively involved with the UK government as they seek to develop the toolkit that we've mentioned before in terms of disclosure regimes, transition plans, taxonomies, but we're not actually a key decision taker in those groups. We're typically observers in those groups, and we can contribute some of the expertise that we have. We can look at what we're seeing in the economy and explain how we think these tools might impact the economy and firms. But I see our role very much as one that's kind of, helping in that way, maybe providing some advice. But it is typically for governments to look at the what's going on in the market, as well as the markets regulator in the UK, which is the FCA. Some central banks have the markets regulator and the conduct authorities within their boundaries. In that case, they can be a little bit more involved in the activities, and that's, I think, some of what's seen in other jurisdictions, such as Singapore, where they have all of the activities within a single regulator. But you've touched on what is it's a grey area, and it's constantly an area that we're asked about. Some want us to do a lot more, and we get a lot of pressure. Some want us to do a lot less, and we got a lot of pressure to do less. So we, as ever, seek to tread the right line and do the right activities.
Thank you. Maybe another question from between the comments. Julie asks, are there participant asks if there are examples from the green area that can be inspiring for other sustainability domains, in particular social and human capital development or worker training, investment reporting. I don't know if anyone wants to provide a response to that question.
I can give it a start. The draft standards that are being developed by EFRAG for Europe include reporting on social matters, okay, which I believe are very important because I think it would be entirely wrong, as now both experience and science demonstrate, to believe that there is a financial planet somewhere, a social planet somewhere else, and an environmental planet again somewhere else. And I think we've all now probably understood that social issues and environmental issues were deeply connected. Thus, the concept of just transition that is now becoming widely used. The only small problem here is that social laws and social expectations vary quite extensively from one place to another. Okay, and I think this is again a case where we have to be very careful on the level of granularity, I'm going to use the word, of reporting that we require. I think the minimum, for instance, is, and this is not a minimum, this is a legal obligation, is that the business actually complies with all the social, etc. legislation that applies to it. But does it make much sense actually to ask the business to report on what this legislation is and on how and whether or not is complying with this legislation? I think there is a discussion here to be held on the relevance of what is being reported. And honestly, having to report, which to my understanding is a little bit the direction that the EFRAG, ECRS are taking, reporting basically on what legislation applies to you, I'm not sure this is the most useful investment in reporting. because you're basically reporting on something that you have to do in all the countries in which you operate. I think that is not exactly my view of reporting on social matters, but maybe Sue has something to contribute on this as well.
Yeah, the question was whether there was anything inspiring. I think I would agree with Olivier that we're going to be very we're going to look at other issues beyond climate, obviously, and one of the candidates that often comes up is social aspects, human capital in particular, and particularly sort of aspects of so-called just transition, which Olivier was just alluding to. The consequences on people of transition is very real, and that's something that's increasingly interesting to investors. I think what is going to be key is to identify the things that really matter from an investor perspective, as opposed to a compliance or a sort of hygiene perspective, for want of a better word. And so that's going to be an important consideration for us. What's going to be really important for the ISSB is going to be what our stakeholders think we should work on next. And we're actually at our first board meeting next week in Frankfurt. One of the first things the new board's going to discuss is a paper that the staff have put together with some potential candidates of additional topics or sustainability matters that may be important for the board to look at. And our plan is later this year to go out and ask our stakeholders for their opinions on this, but sort of aspects of human capital, including sort of intangibles, so the value of your workforce to support the upside of some of these issues is a potential candidate in that list.
Yeah, I don't know if Chris also wants to comment on this, as it's more reporting related.
No, that's fine. In the interest of time, happy to not.
Yeah, then maybe I see we're quite close to the end. So maybe I would ask every speaker to shortly just provide his or her reflections on today's discussion, and what do you think the main priority should be right now, or what is the takeaway message from this discussion? Maybe Olivier can go first.
Thank you, Simon. Well, my key takeaway, I think, is that reporting is essential, but it's not a magic bullet. It's a means to an end, and what matters really is the end. It's not achieving perfect reporting for the beauty of the art of reporting. I think that would be totally misleading. What reporting needs to show is that change is taking place, and unfortunately, because we're late, this change is now very urgent. So it is a global change that we need, and I think we all need to put whatever pride or beliefs aside, and join forces and collaborate to help achieving this change.
Sue?
I agree with what Olivier said there. Maybe just to add a couple of things. I think that what we're looking at here from a reporting perspective is one piece of a big jigsaw, and it's a really important missing piece, but it is one piece, and we should keep it in perspective. We need information that's comparable, that's robust, and that people can really rely on to make the decisions they need to make in this space, and that's our job. And I think really we have frankly, I feel like I have an obligation to work with others to make this as efficient and effective and as streamlined as we can to affect the change. I think that the other thing I should add, though, that I haven't mentioned so far today, which is also really important, is we can write really great disclosure requirements. That's our objective, but it is only one piece of the puzzle. We need to make sure that then we have capacity building to make sure people are capable of providing the information. We need to make sure that we have the environment to support the robust provision of information, the correct sort of assurance processes, etc., to support it. And we really do need the regulatory adoption, I think, of these proposals as well, to make sure that we have consistent requirements and that this information is a necessary part of what's provided to effect this change. And so there's many players in this field that we sort of need all to work together well to get the right information out there to facilitate this good decision making. And I think everybody that's on this call today, we're all sort of partners with different roles in that, but it is a time for people to really to be cooperative and to work together to get the best possible outcome as quickly as possible.
Thank you. Chris?
Yeah, the only thing I'd add is that it is essential that we get the right toolkits in place, and for all the reasons we've heard, it's essential that we do it as soon as possible. There's a really difficult balancing act here, though, between ambition and actual delivery. The more ambition we have, the harder it is to deliver, but we shouldn't be unambitious. We need to be ambitious in order for the toolkit to be useful. So that just shows that there is a huge need for us to work together, to combine our efforts, to not be duplicating our efforts, and that is why groups like the ISSB are so valuable at this point in time. So we need to support the ISSB, continue dialogue, and groups like the ISSB to make sure that we can all deliver in as harmonised a way as possible. I think the next year is going to be very important for seeing how that goes.
Thank you. So I think the main takeaway of today's discussion is that standards are urgently needed, but are a means to an end, and that it's only a start, and that the real action that the real action is also required in other areas. So that brings an end to our discussion today. I would like to thank the UK mission for their support to this event and to our projects on sustainable finance, all the speakers for their valuable contributions and insights, and of course also all the participants for joining us and for the discussion during our Q&A session. If you would want to watch this event again, recording will be made available on our website in the coming days. And please also have a look at our website to take a look at the paper that we wrote as part of this project, which discusses much of the same topics that we discussed here today. So happy for everyone to have a look. I look forward to seeing hopefully many of you again at future events at EPC, and please also keep an eye on our website to see what the future what events we will have in store for you in autumn. So thank you to everyone, and hopefully see you soon. And thank you for joining. Thank you very much.
Thank you. Bye-bye.